Okay, welcome back. So let's continue our content. We just finished the characteristic of the corporation. So there's some basic concept about the companies. We also mentioned two things on balance sheet. So two items for equities, share capital and retained earnings. Okay. So did you find out the share capital before we just asked you to skip this part, right? Because we didn't cover that yet. But right now we are going to talk about this part. So for our second part we want to talk about is, before that, you already know what is share capital, right? So share capital is the owners. So we have so many owners, so it's impossible that everyone could join the company's operation. Anyone could make the decisions. So that's why we have a board of directors. A board of directors are individuals elected by the shareholders to govern a corporation. So from the shareholders, we will pick up actually the major shareholders to sit in the board of directors that make any decisions for every shareholders. Okay. So we talk about this before. Right now, we talk about this part. Why we have a dash equity. This one, okay. That's why for shares, your company try to sell the shares to public, to investors, trying to get the money from investors. Actually, your company could sell two kinds of shares. First kind of shares, we call it ordinary shares. Second kind of shares, we call it preference shares. So what's the difference? The key difference is when your company just sold only one shares, usually is ordinary shares. So it means what? It means right now when you go to the public market, you buy the shares, you sell the shares. We talk about ordinary shares. So what does that mean, ordinary shares? Actually, when we mention owners, we mean ordinary shares. So the true owners of the company is ordinary shareholders. So when you buy the ordinary shares, you are the true boss. Okay, so if you buy another one, so what's another one? The second one, preference shares, you are not the owner. Okay, so when we talk about the owners, we mean ordinary shares. So only ordinary shareholders are the true boss. Okay. So since you are the true boss, how many rights you have for the boss? Fourth. So you are the boss. The first right you have is voting right. So what's a voting right? It means you are the true boss. You can make any decisions for the companies. So when you sit in the board of directors is consists of ordinary shareholders. So you can make any decisions for your companies. Then how to make the decisions? Usually you could vote. So you have the first right, voting right, to make the decisions for your companies. You are the boss, ordinary shareholders. So the second right you have is dividend right. So what's dividend right? You are the boss. The company's profit belongs to the boss. So of course you have the right to share the profit. So how to share the profit? Through the receipt of dividends. So dividends means share profit to shareholders. Okay. So you are the boss, of course you have the right to share the profit. So you have the right to get the dividends. So there's a second right you have. The third right you have is preemptive right. So what's preemptive right? When your company need money, your company could sell new shares to the market again. Okay, but what's the effect for shareholders, for ordinary shareholders? Okay, for example, if at the beginning here your company issued shares. So when you issue shares here we mean the ordinary shares, okay? Because we talk about ordinary shares right now. We talk about the true boss. So when you issue ordinary shares, okay, and you decide to issue 10 shares, for example, you decide to issue 10 shares to investors, okay? So you have a shareholders A and shareholders B. For shareholders A, decide to buy your company's shares, 20 shares. Okay. Oh, sorry, not 20 shares. 2 shares. The remaining shares purchased by shareholders B, so decide to buy 8 shares. Okay, we've mentioned shares. Shares represent the ownership. Ownership means how many rights you have in the company. So that's ownership. So here we mean that's your ownership. Ownership means how many powers, how many percentage you have in the company. So that's ownership. So 2 shares means how many ownership you have. Let's look at this way. Ownership. Ownership usually we describe it in percentage. So for the shareholder A, how many percentage shareholders A have in the company? How many power shareholder A have in the company? Should be totally 10 shares. Shareholder A have 2 shares. So it means 20%. How about shareholder B? Totally 10 shares. Shareholder B have 8 shares. So it should be 80%. Okay, so 20%, 80%, we use it to describe your power in the company. So for shareholder A, when they want to have a voting right, do you remember the first right, voting right? They want to vote. Always, who wins? Shareholder B. Why? Because shareholder B have 80% power in the company. So ownership means your power, means your right in the company. So comparing these two, it seems shareholder B have a totally control in the company. Okay, so for shareholders, the very, very important issue they care about is the ownership, is the power they have in the company. Okay, so when your company issue 10 shares at the beginning, you find out the shareholder B have 18% power in the company. But what's the problem? If a few years later, or maybe a couple months later, your company need more money, or because of some reasons, so your company decide to issue more shares, ordinary shares in the property market. Okay, so maybe your company decide to issue 20 shares more. So your company got the cash. But what's the effect for shareholder B and C? Shareholder A and B, their ownership. If you decide to sell all of these 20 to shareholder C, for example, okay, then what's the effect for ABC's ownership? For shareholders A, right now, still, they have 2 shares, right? So because they didn't buy any shares more, so still 2 shares. For shareholder B, A shares. Oh. The same. So how about shareholder C? The new shareholders, okay? Right now, they have 20 shares. So what's the ownership they have right now? For shareholder A, 2 shares, the ownership means totally how many shares the company have? 10 at the beginning. Right now, 20 more. So totally for the company have 2 shares plus 20 shares. 30 shares for shareholder B only have 2 shares. So what's the ownership? Shareholder A have 2 divided by 30, right? So 2 divided by 30 should be 6.67%. How about shareholder B? Totally 30 shares for the company. Shareholder B only have 8 shares. So the ownership will be 8 divided by 30. 20, then ownership will be 26.67%. Okay, how about shareholder B, the new one? Totally, the company have 30 shares. Shareholder B have 20 shares. So the percentage ownership will be 20 divided by 30 will be 66.67%. Okay, so for this case, did you find out? For shareholder A and B, their ownership decrease, right? So their ownership decrease from 20 to 6.67%, from 80 to 26.67%. So it's a big problem for shareholder A and B. They are the existing shareholders. They are the shareholders at the beginning. So their ownership decrease. Ownership decrease means their power decrease in the company. So their ownership decrease means their power decrease in the company. So that's a big problem for shareholder A and B. They think, how could you do that? You want to sell more shares. But that made my power shareholder A and B power decrease in the company. So that's a big problem for shareholders. Because of that, they decide to give shareholders A and B a right. So what's the right? The right is preemptive right. So what does that mean? It means when your company wants to issue more shares, your company wants to sell more shares, you should ask the existing shareholders A and B, you should ask them if they want to buy it. to keep their ownership the same. So you should ask them first. If they don't want, they want to give up, then you can ask others. You can ask shareholder C. But before shareholders A and B made a decision before that, you cannot sell new shares to other investors. Why? Because you want to protect shareholders A and B to make they have the same power, same ownership in the company. So that's preemptive right. Okay? So in this case, since new shares will make shareholders A and B their ownership decrease, so you cannot do that. Preemptive right means for that 20 shares, you should ask shareholders A and B if they want to buy it or not. Okay, so that's preemptive right. But don't forget, the purpose is to keep their power, their ownership the same. Ask them to keep ownership the same. Okay, based on that, so what's the maximum shares A and B could buy it? Okay, so for A, have to keep ownership 20%, right? So how many shares shareholder A could buy to keep 20%? Okay, so will be 4, right? Yeah, so could buy 4 shares more. Okay, when shareholders A buy more shares 4 shares more, the ownership will be, totally the company 10 plus 30. For shareholders A, before have a 2, right now buy 4 more. So the ownership will be 20, the same as before. Okay? So how about shareholders B? The ownership before is 80. So how many shares shareholders B could buy to make their ownership the same? 60 more, right? 60 30. Yes, 60 shares more. Okay, so after shareholder B buy 60 more, so before, how many shares it has? He had 8. So before 8 shares, right now buy 60 shares more. So totally the company have 10 shares plus 20 shares. So there will be 24 divided by 30. Yeah, so 80%. So did you find out? They will keep the same ownership as before. So that's preemptive right. So what's preemptive right? Preemptive right means when your company try to issue more shares, you should ask A and B, the existing shareholders, the original shareholders, whether they want to buy or not. Ask them first. They could give up, or they could decide to buy it. It's on shareholder A and B's right. Okay? But what's the maximum shares they could buy to keep same ownership? Okay, to keep same ownership. So that's the maximum shares they could buy it. Okay? Yeah, so that's preemptive right for the both, for ordinary shareholders. Okay, so that's the third right. So still remember how many rights they have so far? First, voting right because you are the boss. Second, dividend right because you are the boss. You have the right to share the profit through dividends. Third, preemptive right. So when the company want to sell more shares, they should ask both. Why? To keep the both have the same ownership, same power in the company. Okay, that's right. The both ordinary shares or ordinary shareholders have is residual claim. So what's a residual claim? It's a bad situation is when your company go bankruptcy. It means your company is going to close, maybe because of financial crisis or because you don't want to run the business anymore. So because of any reasons, your company decides to close. So you have to sell every asset you have, right? So you have the chairs, you have the computers, you have equipment, you have printers, you have the buildings, you have the land maybe. So you could sell everything and trying to get some cash back. But when you got the cash back, who you should pay the money? Who you should give the money first? Okay, so we talk about who have the right to get the money first. They have the first priority when your company go bankruptcy. Always, who have the first priority? Always creditor. Why? Because creditors, they are outsiders. Okay, so the law always want to protect outsiders, want to protect creditors. Why? If you don't protect creditors, if you don't protect creditors, the bank, they won't lend the money to the companies. Why? Because they're too risky for creditors. If I lend the money for bank for creditors, if they lend the money to the companies, but they cannot make sure they will get the money back, who want to do that? So that's why no matter any situations, always first priority is creditors. We need to protect creditors, the outsiders. Okay, after that, who is the second priority? We will talk about this. Preference shareholders. Preference shareholders is not the owner. It's not the owner. Okay? Oh, sorry. It's not the boss. It's not. So did you find out when your company go bankruptcy? Who has a major responsibility? Of course, the boss. So ordinary shareholders, you are the boss. So you are the boss. When how to operate the company is the boss responsibility, right? So since it's your boss responsibility, you should take the responsibility. So you should take the responsibility means what? When the company go bankrupt, sold out every assets, you cannot take the cash first. You should take the responsibility. So let outsiders, let creditors, preference shareholders, let the preference shareholders take the money first. So if after you pay the debt, creditors, after you pay the money to preference shareholders, still you got the remaining left. Yeah, you are the boss. You can take the remaining. So ordinary shareholders, always, you are the boss. You should take responsibility. So you should take the responsibility means you cannot take the money first. Besides, if you run the company, if you operate the company better, you will get more. But when the company you run, you operate badly, that's your responsibility. So you cannot take the remaining money first. Okay, so that's residual claim about the priority. Remember, outsider creditor always had the first priority. And the second one, preference shareholders, because they are not the boss, so they are the second priority. Ordinary shareholders, you are the boss, so you should take the responsibility, so you are the last one. Okay, so there's the 4 rights the ordinary shareholders, the boss have. Okay, so we go to the second shares. Preference shares. So it's an additional class of shares. Okay. So as we just mentioned, preference shareholders is not the true boss. It's not. The true boss is ordinary shareholders. Okay. So preference shareholders, they are not true owners. Okay, so they don't have the 4 rights we've mentioned. The 4 rights only belong to ordinary shareholders, the true boss. So how about preference shareholders? Preference shareholders, they don't have their 4 rights because they are not a boss. But they want what they want. They want 2 priority. Okay? So they want 2 things to right before the boss, before ordinary shareholders. So what are these 2? Okay, so they have the 2 preference priority over ordinary shareholders. So these 2, so here is preference shareholders always have a 2 priority over ordinary shareholders. Okay, first is dividends preference. About dividends, we've just mentioned ordinary shareholders, true boss, have the right to get the dividends, right? Yes. But for preference shareholders, they don't want to become the boss, but they only want dividends. They want dividends. So that's why we have to make sure they get what they want, dividends. Okay? So that's why when the company wants to give dividends, you should give to preference shareholders first. Okay? After that, we have the remaining dividends belong to both. Why? Because that's the only thing, dividends, only thing preference shareholders want. When they buy the company's shares, they want dividends. That's it. So you should make sure, protect, they have that dividend. Okay? Second one, liquidation preference. Liquidation preference is just like we've mentioned here. Okay? So when your company go bankruptcy, preference shareholders have a priority over ordinary shareholders. Okay? So there's a second priority. Second priority preference shareholders have. Okay? Okay, so we mentioned dividends. Always, preference shareholders have the right to receive dividends before ordinary shareholders, because dividends is the only thing preference shareholders want. So you should make sure they get it. Okay. Then, so we go to about the things about the dividends. So preference shareholders, they don't have the voting right. Okay, so it means they are not a true boss. So the 4 rights belong to owners. Of course, they don't have. Okay, because they just want cash dividends. They want dividends. So when your company sell preference shares, when your company sell the second one, preference shares, at that moment you told preferred shareholders how much for the dividends they will get. Okay, so that's fixed. So it means what? It's quite similar to the note or bonds, So for the bond, for the note, company will tell the creditors contractual rate, right? So company told the creditors maybe 5% of interest you will get. So fixed 5%. So the same about the preferred shareholders. Preferred shareholders at the beginning when your company sell the preference shares, you told them, I will give you the fixed amount of money each year. So it doesn't matter your company have a better profit or not. It's none of preferred shareholders' business. Because your company have a good profit or bad profit, that's about the boss. Okay? So they could get only fixed cash dividends. Since the beginning, your company told preferred shareholders, you are not the boss, so you cannot get more because you are not the boss. You can get only fixed cash dividends. So when your company sell preference shares. At that moment, you told them, okay, maybe you can get 5% on $20 par value. So remember what is par value? Par value is on this share. So this share we call it preference shares. Preference shares. Okay. So on these preference shares, we have the number on the share. So this 20 we call it par value. So what's par value? Par value is the value on the share. Okay, so when you sell this share to the preferred shareholders, you told them, I will give you 5%. So 5%, how much? 5% on $20 par value. So in this case, you will told them 5% times par value 20. So you told them each year or each quarter, each year, I'll give you the same amount of cash dividend, $1. Okay? So this is the first way to tell preferred shareholders how much of a dividend they will get. 5% of the par value, so will be $1. Another way is you just tell them the amount directly, $1. So either one, they are the same. Just tell them you have the same amount of cash dividend, $1. Okay? So that's about the dividends. So they have the first priority, dividend preference. So they only get the fixed cash dividends. Fixed. Okay. Second one, we've mentioned already, when your company go bankruptcy, so you have to protect outsiders. So protect outsiders, you will protect creditor first. So when you sold out your assets, you got some money, some cash. You should pay the debt, give to creditors first. After that, you still have the money. You should give to preferred shareholders. Okay? Then after that, you still have some money left. Then the boss could get the remaining. Okay, so far it's about the two kinds of shares we have. First one is ordinary shares. So it's a true boss. Second one is second one is preference shares. Preference shares. So it's not the boss. Preference shares, they only want dividend. So they have two kind of priority. So first one is dividend preference. Second one is liquidation preference. Okay? Yeah. So after that, next we are going to talk about, since you understand we have two kinds of shares, then we want to talk about when your company decide to issue shares, to sell the shares to the market. We have three basic questions you need to note. Okay, so before that, take a break. Think about the content we've covered. So please pause the video, take a break, 5 minutes, and come back. Okay? Okay, welcome back. So we talk about the two kinds of shares, right? First is ordinary shares. It's about the true boss. So when you buy the ordinary shares, you are ordinary shareholders. And the second one is preference shares. So it's not the true boss. So if you decide to buy the second one, preference shares, you are preferred shareholders. You are not the true boss. Okay? So no matter what, when your company issue shares, sell the shares to the market, we have three basic questions you need to know. First is authorize. Okay, we'll talk about that. Second is how to issue the shares. Third is what's the value your company assigned on the shares. So we talk about these three issues, the basic ones. So after we finish these three basic issues, we will go to accounting. So how to record all of these things. Okay. So first one, authorize. What does it mean? So you should understand the term authorized shares. So it means at the beginning when your company decide to start up the company, you should apply to the government because we've mentioned corporation, you are the big company. So you are big companies. The government always have so many requirements, rules for your company. So at the beginning, when you decide to start up a big company, you should apply to the government. Then when you apply to the government, one of the requirements the government said is they require X. How many the amount of shares your company is authorized to sell. So authorized, it means you got a permission from the government. They allowed how many shares you could sell to the market. Okay, so that's the maximum shares you could sell in the market. So that's a maximum shares you could sell. Okay. So when you know your maximum shares could sell to the market, remember at the beginning when you apply to the government. So when you apply to the government at this time, okay, then the government will say, okay, we expect how much money maybe you need in the future. So based on the capital, the money you need in the future, they will say the amount of shares you could have to sell in the future. So, okay, so maximum there's the expected is not true because you didn't sell the shares yet. You just apply the government, you want to start a company. So at that moment, you should know. Okay, so when you know what's the amount of shares you could sell at the time of you start out the company, so at that moment, so the amount you could sell is estimated based on the capital you need, but that's estimated because it didn't happen yet. Okay, so after you apply to the government will say, okay, I think you expect in the future the capital you need, how much money you need. Based on that, I allowed permit how many shares you could sell in the future. Okay, so did you sell yet? Not yet. So no, not any business, not any transaction happened yet. Okay, just an application process. So do you need to do accounting things? No, you don't need to. Why? Because it's not a transaction. We don't have any effect yet because you didn't sell it to the market yet. Not yet. Okay, so you don't need to do any accounting jobs. You don't need. But we want you to put the information on financial statements. So you should put the information on equity section of balance sheet to tell them what's the maximum shares, authorized shares your company have. Okay, so here is Apple company. So for the equity, for the balance sheet, equity section, so they will tell you what's the maximum shares they could sell. This one, authorized. Did you find out? Authorized. Okay, so authorized shares is the much shares they could sell in the company to the market. Okay, so there's authorized shares. Okay, so for authorized shares, we look at this case. If assumed the government give you a company totally 10 shares you could sell to the market. So in the company you have the authorized shares 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, totally 10 shares you could sell to the market. But will you sell all of it? No, usually you don't. Why? Because even though you need the money, but the money we think in the future, not only this moment. Okay, so you think about in the future total money you need in the future, maybe 10 years, 20 years. Okay, so it's not this moment. So this moment, maybe you just need to sell to the market, maybe 4. Okay, so for the 10 shares, you really sell to the market only 4. Okay, so in your company, you have 6 shares you didn't sell yet, and you sold 4 shares in the market. Okay, so we called the 6 shares in your company is unissued shares. Unissued shares means didn't sell it yet, so still in your company. So you sold to the market is 4, right? So we call it issued share. Issued means sold to the market already. Okay? So did you get it? Did you get it? So you have a total 10 shares. Authorized shares. You know it when you apply to the government. After that, you sold 4, so that's issued shares. You still have the 6 didn't sell yet in the company. That's unissued shares. Okay, so did you find out authorized shares totally 10? Then you sold 4 shares. 6 you didn't sell yet. That's unissued. Okay, so how to get authorized shares is unissued shares 6 plus issue share 4. Okay, so how to get a 10 is 6 plus 4. Okay, any questions? If you don't have any questions, Actually, we have two practice. First practice, I forgot to ask you practice. So please go to the note. Please, before you go to a note, you should download the note of chapter 12, okay, from portal. So if you didn't yet, please go to the portal to download it, okay? So here's a note for chapter 12. Go to the second page. So actually, I forgot to ask you to practice. So it's okay. Page 2, practice. We have two practice. First is about dividends. We've just mentioned for preferred shareholders, they have a fixed cash dividends, right? Okay, so here's the case. Please finish the case. For this one, the example told you your company have issued two kind of shares, okay? So first kind of shares is ordinary shares. So you have 10,000 shares for ordinary shares, okay? Then how much? You sell it to the market, you got a cash, $100,000. And you have a second kind of shares is preference shares. So how many preference shares you have? 200 shares for your preference shares. And you get the cash how much when you sell it to the market? $150,000. Okay? And here did you find out 5% is, we talk about the cash dividend right here, right? So 5% we talk about the cash dividend we promised to give the preferred shareholders. Then 5% how much? Times their face value, par value. So par value is $100, okay? So here $500 is par value, is the value on the share, okay? So today, based on these two shares, today your company have a net income $30,000. You have a beginning balance of retained earnings $400,000. Your company decided to pay the dividends this year, $50,000. Okay? So first question for dividends. Remember, preferred shareholders have the right to get a dividend first, right? Then how much? 5% based on the par value. And how many shares they have? 200 shares. Okay? So could you tell me how many cash dividends preferred shareholders got? Okay? And about the ordinary shareholders, they got the remaining, right? So after you pay the cash dividend to preferred shareholders, ordinary shareholders, you are the boss. So you got the remaining. So how much? Okay? So finish this part and you figure out what the cash dividends. Then please prepare your balance sheet, equity sections. Okay? So equity sections right now, you should note. Share capital, if you remember, is about how much money investor invest in your company, right? But right now, did you find out here we have preference and ordinary because we have two kinds of shares. So you should tell them preference shareholders, they invest in the company how much. Ordinary shareholders, the true boss, they invest in the company how much because they are the two kind of persons, right? And the retained earnings, how to get the retained earnings? Beginning retained earnings plus net income minus dividends. So you will get the retained earnings. Okay, so please finish this part. The second part, we just talk about authorized shares. So authorized shares, remember, there's a maximum shares you can sell. So how to get the authorized shares is when you apply to the government. The government permit allowed you to sell the shares, the maximum amount. Then you will issue some shares. Still, some shares didn't sell in the company, okay? Okay, so based on this, finish this one. Tell me on issue shares, how many? Okay? So take a break, finish this one. After you finish second page, then come back to here. Okay? Okay, welcome back. I hope you finish the page 2 by yourself because, depend whether you understand it or not. It's all about you. Okay, so let's look at the first one. Preference shares. How much the cash dividend they can get? 5% times par value times how many shares they have? 200. So they can get totally cash dividend for preferred shareholders $1,000. How about ordinary shares? You are the two boss, so you got the remaining. So cash dividends paid for this year $15,000, right? So after you paid to the preferred shareholders, you got the remaining. Okay, so that's how we get cash dividends for two kind of shareholders. Okay. How about the balance sheet? First one, share capital, but we talk about the preferred shareholders, right? So how much money they invest in the company, right here, right? They invest in the company $150,000. So that's the amount they invest in the company. How about the second one? Ordinary shareholders. They invest in the company. How much? $100,000. So that's why we got $100,000. How about retained earnings? Then you should note how to get the retained earnings. Beginning plus net income minus dividend. So where is the beginning? Here, right? You have the beginning. $400,000. Then plus net income $30,000. Okay, minus cash dividend totally $15,000. So $400,000 plus $30,000 minus $15,000. You got the ending balance of retained earnings. Okay, $450,000. Okay, that's how we finish this table. Then how about the authorized shares? We've mentioned authorized shares is your unissued plus issued shares. Okay, so here is authorized shares. Then part of that you sell to the government to the investors. The remaining didn't sell yet. Is here. Okay, so how to get it? Authorized shares minus issued shares. You got unissued shares. Okay. So that's for the second page. I hope you understand it. If you don't, please ask me or ask anyone else. Okay, so here is the explanation for each one. So you should note what does that mean, the definition. Okay, so let's go back to our second issue. When you sell the shares, okay, we finish the first one, what is authorized shares. So second one, how to sell the shares. So actually, how to sell the shares depends on you are public company or not, okay? So you could direct issue means you are not public company. You are closely held company. It means you didn't sell your shares to the market. You don't. You just maybe ask your close friends, someone you know. You ask them directly. Okay, do you want to be my partner? Do you want to be my shareholders? Do you want to be the boss to operate the company with me? So there's a direct issue. So we call it closely held companies. Okay. Second way to sell your shares is indirect issue. So what's indirect issue? Actually, we mean public company. For public company means you could buy the shares in the market. You could buy the shares in the market like Apple, like Taijidian, like Honghai. Okay, you could buy the shares in the market. So that's indirect issue. So what does it mean? Your company as investment bank to have your company sell the shares to the market. So your company didn't sell the shares to investor directly. Usually you don't. For the public company, they ask investment bank help them to do that. So that's indirect issue. Okay. So that's a second question. How to sell the shares? You could sell it to investor directly, or you could sell it to investor through investment bank. So it depends on your closely or public company. Okay. Second, the last question is how your company set the price. Okay. So it means what? When you try to sell the shares to the market, how much money for the selling price, for the share price. Okay. So actually, it's like when you try to sell your shares, you should note depends on how good or how bad your company is. Okay, you are the good company. Of course, you could sell all the shares with higher price. If you are the bad company, then they don't want to buy your shares. They don't want to buy your owner, your shareholders. So that's why you should sell the shares with a low price. Okay, so it depends on how good your company is. Okay, so depends on how good your company is, including whether in the future you could make a profit, or it depends on right now your company situations, and also for shareholders they care about what? Dividends. So how good for your dividends you are going to share with the shareholders. Okay, so the first three conditions is based on your company situations, your company's performance. Okay, so you are a good company. Of course, your share price is higher. You are a big company. Your company's share price is lower. Okay, you said that. Still have other reasons, other factors that will affect your company's share price. Okay, like right now, COVID-19. So it's not about your company. It's about the whole situations. So they will still affect every companies, right? Including the share price. Okay. Also, the economics, like why you take the course economics. We will talk about the microeconomy, macroeconomics. They also will affect the whole market. So when they affect the whole market, of course, they will affect your company's share price. Okay. So based on the company's personal itself situation, based on the whole situation, the market. Okay. So here, when your company decide to sell the shares to the market, what's the share price you can get? Depends on your company's factors, depends on the market's factors. Okay. Also the same when you sell the shares to the shareholders, they still could sell the shares to the other investors, right? So when they do the business, when they sell the shares between investors, what's the market price? What's the share price they have? Also depends on the same. The company's performance depends on the market situations. Okay. So no matter your company sell to the shareholders at this moment, or no matter or the shares transaction between investors, the same. How to get the share price, market price, depends on companies situations. Depends on market situations. Okay. So here talk about the same thing. No matter is between companies and the shareholders at this moment, or between shareholders and other investors at this moment, share price always is about companies, and it's about companies and about the market and economies. Okay. Okay, so that's all. The second issue. Second question we talk about. Okay. The last question is, what value should the corporation assign to the shares? It means when you look at the shares, you will find the par value. We just talk about the par value, right? So what's the par value? Par value means the value on the share. So that's the par value. Okay. So when your company decide to sell the shares, you could sell two kinds of shares. First is par value shares. So what's par value shares? Par value shares means on the share you will find out the value. So that's the par value. So when you print the shares, for each share you will print the par value on the share. So that's par value. Okay? So that's par value share. But par value shares, they $10 means there's the market value, there's the share price. No, it's not. So this value is not the share price. It's not the market value. Share price. It's not. Like for Apple, for example, if Apple have the share, then they have the par value, maybe $1, for example. But does that mean Apple's share price is $1? No, Apple's share price maybe is $100. So did you find out it's not the same thing? Here is the par value. Here is the share price. So what's the share price? So when you are going to sell the share to the market, the money you can get from investors, that's the share price. So share price means the market value. Okay? So they are not the same. Then why? Since $1 par value is not a share price, then why we want to put that $1 on the share? Because we use that $1 to decide the legal capital. We use that $1 to decide the legal capital. So it means what? If par value $10, means that $10, no matter what, the company cannot use the $10. Okay? So if your share price, so for example, if your share price is 100. Okay? Then par value is $10. So for that 100, we will tell you $10 par value. You cannot use it no matter what. So if you need to use your money only for the $90, you could use. Okay? So $10 means that's your legal capital. That's your legal capital. It means you cannot use it no matter what. Okay? Then why we have this requirement? Before we have this requirement because we want to protect creditor. Because we are afraid if your company use all the money. Okay? So if you use all the money, then who protect creditor? Okay, so that's why we ask your company, at least you should keep $10 in the company. So someday when your company go bankruptcy, you still have the $10 to pay the debt back to the creditor. So that's why they have the par value share. They want to make sure require company have a legal capital par value. Okay, then no matter what, your company cannot use it. Okay, so their amount not available for shareholders in order to protect creditors. Okay, then second one is no par value shares. No par value share means you didn't find any par value on the share. Okay, so there's no par value share. Right now, no par value share is quite common today. Okay, why? Because they think par value, they think this one, par value, even though you want to protect creditors, they think it didn't work. So they think since $10 didn't work to protect creditors, then why we put the $10 on the share, okay? Okay, so that's why par value is immaterial to the market value share price. Okay, so par value don't have any relationship with the market value. So that's the first disadvantage. Since par value is not market value, so sometimes people will get confused. Two numbers, every time when you have two numbers, always you get confused. So first advantage is they will make you get confused about the par value and the market value. Second disadvantage is since you use par value to protect creditors, right? But they find out it didn't work. It didn't work. Why? Because par value and the market value, they have a big gap. If for your company, for example, for Apple, let's look at this one. For Apple, if you have a par value, this number 0.0001, so that's a par value. You use it to protect creditors. It didn't work. Why? Because for Apple, their share price is maybe, I don't know, maybe $20. So 0.00001 is a quite big gap, right? So if you want to protect creditor, you use the par value. It didn't work. So since it didn't work, why you put the value on the share? Okay, so that's why right now no par value is more common. Okay, and also for the no par value shares, some companies, if you want to assign a value to no par value shares, you could do that. So that's static value. Static value means at the beginning there's no par value share, but you decide you want to give some value, you could do that. So you assign any value you want, like Apple. Decide to give the value 0.001. Yeah, you could do that. So that's static value. Static value means you put any value you want on your shares. Okay? So that's why right now it's more common for no par value. Okay? Because par value didn't work. And also, you need a value. You can assign the value by yourself. Okay? Yeah. So, okay, there's a third question. We cover already finished. Then please take a break. After break, we will talk about the shares transaction. Okay, the shares transaction. So actually the whole structure For this chapter, we will talk about first issue, when you sell the shares. Second issue, when you pay the dividends, right? Because the shares, we need to pay the dividends. Then, third issue, when you buy back your shares. And the last issue, when you resell your shares again. So actually, for this chapter, we have 4 major issues in accounting. But you should understand the basic ideas. So please make sure we've mentioned the contents, okay? Then take a break.